Hi, this is Matt Holquist, CPA, and in the previous video, we talked about the one critical mistake every business owner makes, and that's not looking at their cash gap. And so I wanted to continue that and go into part two and figuring out where your cash went. Okay, so it's one thing to understand that you have a cash gap. It's another thing to figure out what that cash gap is and how to fix it. All right, so we got to figure out where the leaks are before we can fix them. That's step one, is, where are these leaks coming from? And then we can get to work on fixing them. So the first big area of leakage in any business is in accounts receivable. And accounts receivable is simply what your customers owe you for stuff that you sold them. You send them an invoice, that's accounts receivable. The faster they pay you, the faster you spin that cash wheel that we talked about in the previous video, and the more cash you have for growth. It's not rocket science. It's very simple. The quicker you can get that money in the door from your customers, the more money you're going to have to support your growth. Okay? So how do we figure this out? All right, so let's walk through an example. Let's figure out this accounts receivable leakage, and you can use this in your business. This is not hard to calculate. It's not hard to do. Okay, so we have to figure out the average days it takes your customers to pay you. Now, this is an average, and we're using a simple example, but again, you can do this over different time periods. You can do it for individual customers. Usually, you're going to do it on an average to see what's going on. All right, so step one, let's pull up your balance sheet for the last 2 year ends. So for example, as of December 31st, 2017, and December 31st, 2016. Just get those balance sheets. That's all you have to do. Step two, you're going to pull up your income statement for the same last 2 year ends. So one income statement will be from 1/1/2016 to 12/31/2016. And the second one will be from 1/1/2017 to 12/31/2017. Step three, you're going to look at your balance sheet and you're going to average your ending accounts receivable over those 2 years. Okay? All you're going to do is add them together and divide by 2. Not hard to do. Step four, you're going to average your sales from your income statement over the 2 years. So you're just going to add the sales together for each year and divide by 2. Step five, you're going to divide the result in step four, which is the average sales, by the result in step three, which is your average ending accounts receivable. And then step six, you're going to divide 365, because that's the time period we're using, 1 year, by the result in step five. All right? So the result in step six is how long on average it takes you to collect your invoices from your customers. The lower, the better, okay? The technical term for this is days sales outstanding, but basically, if you boil it down, all it is how long it takes your customers to pay you. And yes, the lower, the better. All right, so let's do a quick step-by-step example. Let's say in step one, we pull up our balance sheet and the accounts receivable at the ending dates was $110,000 and $78,000 respectively. Step two, sales for 2017 and 2016 were $1,000,000 and $900,000 respectively. We're pulling that directly off our income statement. So step three, we're going to average the accounts receivable. That's $110,000 plus $78,000 divided by 2 is $94,000. Step four, average sales, $950,000. Okay, so step five, the result in step four divided by result in step three is 10.11. All right, that's $950,000 divided by $94,000. Step six, 365 divided by the result in step five is 36.1. All right, so what does that mean? Well, first of all, it means that if you have bad accounting or bad bookkeeping, you cannot figure out these amounts. You just simply can't. And so this is crucial to have that good accounting, that good bookkeeping. Otherwise, you will have bad data and you will not know how long on average it takes for your customers to pay you. All right. So this means on average, it takes you 36.1 days to collect from your customers. So is this good or bad? This is great. You got a number. What does it mean? Is it good or bad? Well, that depends. Depends on your industry. It depends on your history. You know, on average in the past, has it taken you 60 days to collect and now you're at 36? Well, that's great. You've incredibly improved your cash flow. If on average your industry takes 15 days to pay and you're at 36, well, then you're not doing so hot. Okay, so you look at the industry averages of your peers. It also depends on how well you're managing your inventory and accounts payable. So if you're paying your payables over in 40 or 50 days, but you're collecting in 36 days, it's pretty good. But if you're paying your payables in 15 days, it's not so good. So it all depends. Okay. So once you figure out this number, how do you stop the leakage? How do you reduce that 36.1 down to 30 or to 28 or whatever it is that your target is? So how do you reduce the days it takes to collect? Well, there's a couple things you can do, and it all depends on your business and your customers and your relationships. But you can put in more stringent credit terms. You can pre-qualify with credit checks or trade references. Okay, so you don't sell to every person that walks through the door. You pre-qualify them. Make sure they're going to be a good customer and make sure they do pay on time. You can put more stringent payment terms. So instead of net 45, net 60, it could be net 30, it could be net 15. You can put in additional payment terms, whether that's in a contract or just on an invoice. You can do early pay discounts. Okay, that's like the 210 net 30. That means that if they pay within 10 days, they get a 2% discount. Sometimes it works, sometimes it doesn't. You can have down payments. Okay, so maybe a customer has to put a down payment down, half down if they're a new customer until they establish credit with you. You can look at your customer mix. Okay, a lot of times I see small business, they go after these big whale customers. You know, hey, I want to sell to, to Walmart or to, a BMW or somebody like that. Well, that's great. But a lot of times their standard payment terms are 60 days. So if you have too many of these big customers, one, you're probably going to get lower margins. And two, you're not going to get paid for a while. So get some of the smaller customers in there. Some of the ones that, yeah, they're a lot smaller, but they pay within 15 to 20 days, and you are getting a little bit better mix in there. So you've got some big customers and you've got some smaller customers. So look at that mix. You can assess finance charges, of course. You can send statements every single month. And the biggest thing that I've found that works is you're constantly dialing for dollars. You have got to stay on top of your accounts receivable, and you have got to be reminding people that they owe you money because that squeaky wheel gets the grease. And if you're not doing it, they're gonna take as long as they can to pay you. Okay? So you've got to stay on top of this, whether it's you or it's somebody in your office. All right? So those are some ways. You've got to figure out how long it takes to have your customers pay you, and then you've got to figure out how to reduce those days that takes, and you will increase your cash flow. Okay, but that's just one step of this. Okay, so I'm going to do a couple other videos as well where we're going to figure out how long it takes you to sell your goods, how long you take to pay your bills, and then put it all together and figure out what your cash gap is. So we've got a couple of numbers that we figure out, how long it takes customers to pay you, how long it takes you to sell your stuff, how long it takes you to pay your bills, and then we can figure out what the cash gap is and what the impact of that is on your bottom line. And the goal with all this is to increase your cash flow, which is critical for any business. This is Matt Hultquist. Hope you enjoyed this video, and I will be doing these additional videos in the coming weeks. Hope you enjoy.